The technical definition of a CFD is a leverage-based product that allows you to trade the financial markets without owning the underlying asset. Let me explain. There are three major features to trading CFDs. Firstly, leverage. If you wanted to buy £10,000 of shares in Barclays, you would need £10,000 of cash. Using CFDs, you can assume the same position by putting up a £500 deposit and leveraging the balance. This is an example of a 5% margin rate. We have the most competitive rates in the city, with the FTSE 100 currently being traded at 5 to 8% of total position value. As you can see, the use of leverage has the effect of amplifying your exposure to the market for the available capital you have. But please remember that both profits and losses can be magnified. The second major advantage of CFDs is the ability to take short positions. This means you can potentially profit from a falling market or share price. With normal shares, you can only look to buy low and then sell high. With CFDs, you have the flexibility to buy low and sell high, but also to sell high and then buy low. This allows you to potentially profit no matter which direction the market takes. An example of this would have been to have shorted the banks during the financial crisis in 2008. So if you were to sell Barclays at 300 pence and the price fall to 285 pence, you could buy back the position and close to make a profit. And as you can imagine, this strategy has become very popular amongst savvy investors during the recent bear market. Thirdly, CFDs are not liable for UK stamp duty, as they are with physical shares. Stamp duty is currently 0.5% of the total transaction size, so on a £10,000 position with normal shares, the stamp duty would be £50, whereas with CFDs, you're not liable to pay this. Please go to the example page on our website, www.jnfinancial.com. There are a few other points to remember regarding CFDs. They can be used to hedge against your current stock portfolio. So if you have a large position in, say, Marks & Spencer's, and you think in the short term the share price may go down, then you can open a short position using CFDs to hedge your exposure. Also, you can trade all the major indices, such as the FTSE 100, the Dow Jones and the CAC 40. Alternatively, you can use CFDs to trade commodities, such as oil or gold. All work in the same way as trading a stock. Please note that the value of an investment in a contract for difference may be affected by a variety of factors, including but not limited to price volatility, market volume, foreign exchange rates and liquidity. CFDs are a short-term trading tool, and commission is charged on the leverage amount, not the deposit, and therefore costs can build up when frequently traded. You should evaluate potential losses against affordability. JN Financial are authorized to give advice on investments, including CFDs. However, extended runs of losses as well as profits can occur, and past performance is not necessarily a guide to future performance. Trading in contracts for difference may not be suitable for all investors due to the high-risk nature of the product. You may lose all of your initial stake through the use of leverage and may be required to make additional payments by way of margin on a frequent and sometimes daily basis. Failure to do so can result in the closure of part or all of your position. If in any doubt, please seek further independent advice.